Hi everyone, this is Sameer Singh Jaini here. Welcome on board. I think this subject obviously is pretty interesting. I think we've seen a lot of people joining in here, and idea of this session is primarily to give you a feedback on what we understand from this new regulatory framework which RBI has shared. We'll keep it one way for to some extent, but obviously you can share your questions back on the chat, and we'll try to respond back on that. So that's the intent, that we'll try to give as much feedback as possible. But of course, one key aspect I want all of us to sort of accept is that nobody knows the full truth, right? So it'll be difficult for us to say, is it a regulatory response to everything? But yeah, I think the idea of this session is primarily to get a feedback on what we understand on the document itself, and what maybe you can think about as we go forward. Many of us, you have reached out to us in different contexts, different thought process.
I think that's, yeah, he probably.
Just yeah. Okay, so I think we'll keep moving. Keep yourself on the silent mode, and that's how my request is. So with this, I start a quick session now, and please raise your question if you have on the chat. That's a request. Just said, because if you ask in between it, I think we may not be able to sort of respond back on those questions immediately, right? So that's my request. Otherwise, that's about it. So we'll just start now. Just one sec. Yeah. Just one sec. I'm just getting my deck out, right? Just one sec. Yeah, here you go. So as I said, the intent of this session is primarily to get you understanding of what we figure out. We have figured out, and we have spent some time going through it. We have also had interaction with industry seniors. It's very little to say that what is right or wrong, but we'll still try. And again, please don't take it as a legal perspective saying that this is what we've done. I think there'll be a damage to that. So please take legal opinion on that if that is required. So a quick feedback. So many of you would have joined us for the first time. My name is Sameer Singh Jaini, and I'm part of the Digital Fifth Firm, which is a consulting firm in the fintech domain, and we have been there for now 5.5 years. I think next year we'll be sort of finishing our 6th year. In terms of work we've done, we have grown across the country and worked across segments. Lending obviously has a big choice for us. Anushka, can you just keep everybody on mute, please? Yeah. So I think that the intent is obviously we've been growing in the market all through, and we have clients worldwide. Of course, our base is only in Mumbai and Bangalore, but we are expanding as well. And we work across the network. So we have a very decent outreach program and all of that. So one of the things is that I'm also surprised with the number of people joined, but I think that's also our network, which we have worked with, along with. I think we have had today almost 450 odd people registering for the event. And I guess the peak will be around 30, 140. These are some of the customers we have worked across consulting, training, partnerships, all of that. But we work with across all segments, large entities, small entities, PSUs, and all of them. Quick one, we obviously do consulting, partnership, training, and hiring. This is largely the segment which we operate in, and we do a lot of advisory services across board. This content itself is coming from some of the advisory work we are doing for our clients. And that's what we wanted to bring on board for everyone. But if you want to set up your own fintech, or if you're a bank building your digital business, I think we can always work and collaborate. Open banking is an area where very, very strong. We work with a lot of entities, and of course, program management, we never call out, but we just did one of the largest core banking migration over the weekend, and has worked very well. And of course, courses. This content, what we have done today, is actually part of our executive program, which runs on all Sundays. This particular session will be taken maybe around 2 or 3 weeks down the line. And we run a very long-term course on that, almost 3 to 4 months, and well accepted by the market. A lot of people take our trainings. With that being the background, let's move ahead. And we also do hiring as well. So if you have a hiring requirement, do reach out and we can work it out. Now let's come back to the framework itself, right? What are we saying? What we are saying is that there are 3 kinds of frameworks, or RBI has come back. One is that they are saying that when working capital came, they had three kind of, overall, they had a lot of sort of requests given. But what we understood is that there was annexure A, 1, 2, and 3. That's what they've come out saying, that 1 is fully accepted. So what committee gave an expectation that this is what the recommendations were. Finally, RBI accepted some of them totally, which is annexure A, fully accepted and has to be implemented immediately. While more guidelines will come, I think my request to you, most of you, is that please don't get into the discussion that only when the guidelines will come, we'll start working on it. It'll be too late by then, and and highly avoidable. So please do not wait for it. Start executing this. If you come to a recommendation which is in principle approval, I think they are going through, in principle approved, which means that you need to start working on them right away. Many of them are very directly written, right? If this is not possible, this is not possible. This has to be done, this has to be done. So please start working on it while more clarification will come. And Annexure 3 is actually meant for some other purposes. We'll talk about it as we go forward. So we'll focus on Annexure 1 first, then second, and then of course third. What I will do is, I know many of you will be sharing the questions or your pointers back to us. We'll try to pause in between and share the responses as we go. I think question and answer will only be on chat. So that's my request. Now, in terms of what is it, who is it applicable to? There's a lender type A, which is a regulated entity, and their DLA. Now, DLA is basically digital lending app. Now, any bank, all banks will have their own apps, right? Own mobile banking app, own apps, or even the digital lending portal, which is the internet banking. So it's applicable for banks and NBFC on their own portals, own platform, which is digital sourcing. It is technically not relevant if you source this business through physical branches and you do through manual process. It is not part of the structure. So you don't need to bother too much about that. But it is finally applicable to your framework where you're basically your own app, bank's own app. And then there is lender type 2, which is chit fund, housing society, and some of these which are not regulated by RBI. Right now, it's not mandated on them. I'm sure many of you are coming from this segment, which is the Fintechs and embedded finance player, which are considered under LSPs. So LSPs, let's say, for example, any kind of Fintech is there. I'm not naming anyone because it will be taken controversially. So I'm not naming anyone. But you are an LSP, a lending service provider to any bank or NBFC, it is applicable to you. So I think through this session, primarily it affects them, which is the banks and NBFCs. It affects any of the fintech partners they have or embedded finance partner, including the e-commerce guys, travel guys, anybody who's embedding lending into their segment or any payment or anything else they are doing it. Or sorry, not payment, lending, they're doing it, that will be under their regulation. Payment obviously has got a different connotation. They've come back only or already on regulation for that. Now, first thing, which is critical point, and we'll go and delve into each of these items in detail as we proceed. First, no escrow, no third-party collection possible, which means that most fintechs have a tendency to basically take money or disburse money from their accounts. So what they do, they collect money from the partners, NBFCs, and then lend on their accounts. And these accounts are handled with banks. And also when they collect first from the lenders, from the customers, and then onboard it and share it back to the lenders, right? That's how the process is. This is not going to work, and this will have a fairly difficult scenarios for operation side, from the fintech technology side, and also little bit of a pain point which will come from end to end. So we'll talk about that. Fintechs cannot collect fees from the borrowers. Now, normally what happens is that these entities actually take all the proceeds from the client side, and they may charge some extra service fee, and then pay whatever they collect. They pass on the cost or the charges back to the lender. That's how it works today. Not on all cases, but some of the cases for sure. That's what we have seen on the ground. That's not going to work anymore. So which means that the LSPs, which is the fintechs, cannot take any additional fees from the borrower. How it will work and what are the challenges, how the segregation will have to be done is an issue, because in many cases when they are also embedded finance player, they're also providing other services to the customer. And if they are providing other services to the customer, how will the commercial work, how the charging will work, I don't have an idea. And that's something which is open to questions. Key fact statements. So they have clearly called out that a lot of facts have to be shared with the client upfront. The way you would have seen on the credit card side, that entire costing and everything which is there written out there saying that, was this how I'm going to charge you? And this is how the communication has to be done, all of that. That is not available on fintech side. So that's right now forced that all cost of digital loans in terms of APR and every other fact will be shared. I'll talk about it later. There's a framework of cooling off period, which means that if you take a loan today, let's say you take a home loan for, let's say 5 crore or 2 crore, there's no structure for that. And you take an APR of, let's say 8%, or maybe you take a PL for 1 year of, let's say 14%. After 3 to 5 days or 10 days, maybe anywhere between 3 to 14 days, as the structure will be laid out by the NBFC, and of course in partnership with the Fintech, during the cooling off period or look-in period, the borrower can actually return the money, and if he returns the money, that money is given as per the proportionate APR, which means that if you have collected some level of processing charge from him, the structure, that will have to be refunded. So it's a very awkward flow. We'll have to figure out how it works, but it's complicated. There's also consent-based credit increase. So if you look at in BNPL and many of these products in the market, over a period of time, there's a line of credit given to the customer, and this money or the line of credit kept on increasing with time. So we've seen, I met a customer who said that he used to get maybe around 5,000, 10,000 initially, and now he gets maybe around 25,000 from the same lender. But that lender may not have told him that it is automatic. So it is all automatic in the background done. It is no explicit consent. So they've called out that's not possible. You need to take a proper consent from the customer before you increase the credit limit. Logically correct, but obviously it will have its own impact on the convenience side. So some of the forward-looking guys or younger guys may do it. Maybe senior guys may not do it. So it's again depending on the customer thought process. And of course, there's a lot of thought process brought to the table too for grievance management. How the grievance management will happen, the process around that, redressal, and if that is not done, how it will be reported to RBI. That's all written. So these are some of the key points. Some from a technology perspective. I think the DLAs, which is the DLAs of Fintechs or DLAs of also banks. So for example, let's say HDFC Bank app or ICICI Bank app will also have to cater to same framework. They can only take the data on the need basis. There should be a clear audit trails. Consent also has to be proved at all times. There can be no chances that you've not taken any consent and tomorrow you're not able to prove. You will have this, the way today you have fines given to the customer saying that when they do not do it on time, same thing will come. And the customer can also say that, boss, whatever data you had taken from my side, please delete. Now, what does it mean? From a DLA, it will be deleted, which is app will be deleted, Fintechs will be deleted, or if the deletion happens, how the system works, how the LOS, LMS will work later on when the customer comes back again, difficult to call out, but these are all complicated stuff to work on. Another few points, I think any kind of lending, which is including the tenor and including even if it is the merchant platform on which there's a deferred payment, which is BNPL. So BNPL, any kind of loan given to the customer, any kind of delayed payment expected from the customer, all of them will fall under the digital lending framework, which means that if you are giving a BNPL of, let's say, 500 rupees, you will still have to do a bureau check. You will still have to do I would say, underwriting. You have to do KYC. So which means that the overall process and cost of doing a credit, I'm assuming that onboarding one customer on this whole process of KYC and all will not cost less than 150 rupees. Now, technically, a lot of Fintechs in BNPL will be offering, say, starting with 200, 500 rupees of credit and increasing with time. That will not work. So which means that the barrier or the overheads of getting into BNPL will increase, and BNPL on a short-term side will also have challenges. So technically, this is a quick summary of what we saw. Now I'll delve deeper into each item and talk about what our views we carry. And of course, I'm seeing your chats coming in. So I'll go through it and sort of keep responding back specifically on if I have some responses to. There are some areas where my responses would not be there. I wouldn't really know. And I'll tell you, I don't know, right? So we'll all have to figure out how to do it, right? So coming to the first point, a transfer of fees, right? So normally what happens is that in many cases, Fintechs talk to borrowers directly in terms of transfer of money and fees. So for example, disbursement is done directly by Fintech to borrowers, and fees is collected also directly from there. Repayment also happens directly in many, many cases. Now the framework will only be this. Banks will always be in between. So therefore, there are many fintechs or many banks who may be offering saying that I'm taking a hurdle rate or a basic rate of, let's say, 16%. Beyond that, whatever money you make is you give me a FLDG of 5%, something like that. Now, today, the banks may not be looking at the inflows now, and they will not be part of their top line and bottom line. So which means that today, whatever revenues make, they will be booking the interest out here. But in the new structure, what will happen is that the entire revenue have to be recognized by the bank or NBFC on their balance sheet. So for example, when they can see extra interest coming and then all of that, they have to book in their system. And whatever is the fees has to be paid by to the fintech, they have to put a debit to it. So it will have a top line impact and a bottom line impact. It will look awkward. And maybe many of the banks, when they can see extra money made by fintechs, will come back and negotiate as well on additional money to be done. So in many cases, let's say, for example, somebody is offering a loan to the customer at 24%, and then hurdle rate is only 16%. So there's 8% money to be made. Now, banks may be right now okay to take 16% and sit quiet. But in the current rate, they will have to take 24% and pay back 8%. And that would be sort of painful, right? So how that happens, it's difficult to call out. My overall sense is that many fintechs and many banks will a number of fintechs getting into a scalability side will tend to get into more of an NBFC structure and do co-lending framework more than anything else. And we'll talk about some other repercussions, but later on. But dispersal covered under statutory or regulatory mandate. Okay, very difficult to make out. What does it mean? I don't have an answer. We have to figure out. And loans mandate for specific end use as per regulatory guidelines. My take on that is that while there will be a lot of other use cases, but when the payment is made to merchants, that might just come under the end use. For example, I'm buying product online and I'm buying for, let's say, buying that car or buying that shirt, and the money is going to the e-commerce guy. That might be outside the purview of it, but let's see. That clarification has to be taken from the regulator, and then we'll go forward with it. As I said, the implications are clear. Banks and NBFCs now will have to handle the entire disbursals. Their LOS, LMS systems will have to be changed. They will also have to reverse share the information back to LSPs so that they can handle their systems properly. And in the fact of the matter is that LOS, LMS are across board used on both sides, so the reconciliation is done better. And of course, fintechs will have no control on the capital flows. So incoming and outgoing is not there clearly. And they cannot receive fees. So there's an adverse impact we can see, at least in the short term. And of course, bank customer side is all good. They will not have to pay any extra fees, which fintechs may be charging. And the questions remain, while everybody will go towards NBFC's license, I would say large ones for sure. The question remains is that how these fintechs will charge for any other service they are providing customer, embedded finance kind of services or something else. And there's also a pointer which has come out there that can borrowers have a fully KYC compliant PPI, and then can the money be paid to that? While there is a recommendation that only if the customer doesn't have a bank account, you can do it. It's not clearly written when the responses come up in the document that is it really applicable or not. Very difficult to make out, right? So I suspect that's very, very difficult to make out for anyone. It's going to work or not. So I think these are the questions which have to go back. Can we do this? How do we charge that extra money? And overall, maybe the operations will have to be retweaked. So many of you should ideally do a whole validation of the documentation, look at your repercussions, and start doing impact analysis and development immediately. Many of you will be already running partnership with, if you're a bank or NBFC, you're already running partnership with a lot of entities. Same as the case with fintechs. Please go back and start planning all over again. How do you ensure that you comply with it? Because this is already applicable. While the more details will come, I think you can't get away without execution at this point of time. The days of saying that we will find a placeholder where we can live with it without RBI looking at it, that those days are really, really over. I'll pause for a moment. And I'm just trying to check if there is any question I can read through. Let me just see if I can see some questions. Not too many questions are there. I think one of the question has come is that we have platform which supports invoice discounting and charges as fees from participant of the fees charge qualify for APR. My understanding it would. Any kind of charges laid out to the customer will be framework wise. It's actually, so it's the same case as BNPL, where we don't charge interest, but we charge fees and that will also come under the APR calculation. That's my take. But of course, my request is please take regulatory approve. I mean, I'm not a RBI approved regulatory guy, right? So I'm just trying to ensure that in the fintech domain, how does impact happen? We'll see. I'm trying to read the second question, which just came from someone. Money transfer between lender and borrower can be directed via escrow. We are a fintech would like to, okay. So can be directed to escrow, but still the account should be in full control only of bank and NBFC. Ideally, how fintech will get access to that will still be questioned. I think what they're pushing is that only fintech. So maybe the structure will come is that you will create a TSP structure, and TSP structure will take care of it. I think I don't have an answer for it, but you may have to have a LSP structure and a technology service provider structure, in which technology service provider will have this access. So you may have to formulate that structure that already exists on a PSP or a UPS structure, where there's a technology service provider and there's a payment service provider. So that structure already exists. We'll have to see how it can be sort of structured. Yeah, so I'm just trying to respond back to some questions I saw. I think Ashlesh is asking, when are these guidelines become applicable? Please, the work starts now. We can keep figuring out that. So it's immediate applicable, while more details will come. It's already up and running. At least module 1 or annexure 1 is already applicable. And annexure 2 is also structurally applicable, but they will share more updates on it. You should start managing both 1 and 2, annexure 1 and 2 right away. What do you see the role of RegTechs in this situation? I think RegTechs will have the same role. They will have to keep working as TSP, and they have a lot of work to do because the regulatory requirements on fintechs dramatically go up. So if you are a fintech, RegTech, and you are looking at from a business perspective, I think your business should ideally grow because the regulatory requirements of technology, these entities are becoming end-to-end, and then potentially the banks and NBFC will also expect you to partner with all the the LSPs or fintechs they are partnering with to have the same architecture, so they can actually audit and plan. So I believe it's a positive pointer, at least from a RegTech perspective, although the others may have work to do. Naresh, you are asking about KSF. I'll talk about that in a few minutes. We have sort of created a base structure of how a KSF key fact statement will look like, and I'll talk about it, right? So yeah, I'll just share it. I think same question has come also from Smitesh on the key fact statement, what kind of details should be there and all of that. So okay, I'm just reading as it goes, so you may find it bit of a jarred nature because I'm also don't have answers to it. I'm just reading through. So I think Kaya Krishnan is asking, for an existing bank who has LMS implemented, what is the precautionary step to look at complying into this guidelines? I think while LMS may not be right now, many of these LMSs are not built for direct integration with interaction with the customer, and disbursement is done via fintech. So they basically are taking uploads and downloads from the fintechs, and many times I think they will have to be as agile. So it's ulta ho jayega. This has become inverse, right? Right now, all the complications and integrations were done by the fintechs, and the banks were also saying that, okay, do the basic underwriting with me and then dump data and I'll process. Now that will go away. Actually, it will be inverse. You will have to ensure that your LMS, LOS are talking directly with the customer from update perspective, statement perspective. Everything has to be done from your LOS, and the reverse feed has to be given by you back to the fintechs from a charging perspective and everything else. So your system should be as agile as a fintech, because, for example, all the variable charges you are paying right now, today you may be doing a flat 15%, 18%, and you're not bothered about all the complications with the fintech maybe charging from the customer side. I think that will also come to you, and you'll have to sort of build for it. A lot of work ahead for you, right? That's my take. I'll continue. I know there are more questions coming. Anushka, let's or Mathi, please document them out, what the questions, and we'll try to see if I can respond back on some of that later on. Yeah. I think there's some question which came that there's a recent report on highlights on digital banking license for fintechs by RBI. Look, that is not from by RBI. That's from Niti Aayog. We don't have an answer because both the points are in a different direction. Maybe after a year or two, they may come in the same direction. But right now, what I believe is that this is to ensure that fintechs are more compliant to the regulatory requirements, and they have to comply with the same requirements as if they're an NBFC. And many of them should ideally move towards NBFC structure. They have to figure out banks. Bank license is not easy to get. And I suspect that at least while I had more positive views maybe a year back, I believe that at least for next 18 months or 24 months, licenses are definitely not coming, not at least at this point of time. I'll go back to the slides and we'll talk through and keep sharing your questions. We also don't have answers for all of them, but we'll all learn together. Okay. Anushka, can you just put people on mute, please? Okay. Can somebody please put everybody on mute? Okay, thank you. So let's come back to the Apr structure, right? What Apr is, and I think I'm not going to contest on what Apr is and how it is calculated. But critical point is that when you plan an APR or you calculate an APR, let's say you are a short-term lender and you must be charging, say, you're offering a 3-month loan and you are charging, say, 2% on flat, right? So, and you have a 2% processing fee. So right now, you go to a customer and saying, I'm going to charge you 2% upfront as a processing fee, and then every month I will charge you 2% as flat for 3 months, and I will take the money back on a daily basis or a weekly basis or a monthly basis, and you repay. Now it looks like overall 2% plus 24%, right? It looks like that, but when you convert into APR, it would be upwards of 50%, right? Now suddenly the APR structure will throw a different number to the table, 50% or 60%. I don't know what the number looks, and that and you have to include all the processing fee and any other charges you have laid out on before you do that. So that will ensure that APR structure coming will obviously bring more transparency, more for lender, which is the bank, which earlier was not aware of these APR end-to-end. So they will be aware of it, and they will be obviously under the RBI regulation. They can't give a loan at a higher than particular percentage. So I suspect their controls will come today. Anybody who's offering more than 36% will get curtailed. They will not have a scope, because on a regular balance sheet, let's say 60% to 70% interest rate doesn't look logical. So that won't be permitted or won't look nice. Also, from a customer perspective, it's getting charged 2% and 2% flat is okay, but getting charged 56% or 66% or 80% on APR basis will be too dangerous for them. They will not like it. So I suspect that borrowers will really avoid short ticket loans due to complete transparency, right? So you can't hide under this structure and that structure. In your face, APR will be written. So that's one point that you will have challenges out there. Nothing wrong with it. I think RBI is what here, it's a transparency issue, right? That's pretty fine. We should be doing it, but it's not done. And the customers don't also sort of create or document API. This is already available worldwide. So I think there's nothing wrong with it. It's just that it will have an impact. Also, they're saying that if a fintech is acting as recovery agent, I think that all the communication, who's owning what responsibility, has to be communicated by the bank to the borrowers. In the structure, I think there's already a regulation which came, I think, a week back or 2 weeks back, which actually consolidated all the other earlier regulation recovery. I think you have to follow that. It's already available out there. So I think Anushka or Matthew, if you could share the feedback session of this, although all of those you guys who will give a feedback back to us on the session, we'll share this document back to you for your usage, right? But please use under caution. Nobody knows the full truth. There's also a thought process on grievance officer. So I think this is normally has to be done. So the whole process on who's a nodal officer, and the way you have NBFCs have nodal officers, same has to be done by even fintechs. They have to also ensure that the structure is properly laid off, documented, and there's no controversy on that. That has to be taken care of. And I was also saying that there's a cooling off period, which is not permitted, which is already 3 to 14 days has to be given to the customer. And in this period, the customer will actually have an option to give the money back. Now, and in that case, obviously, the processing fee also has to be returned back to the customer, because if you were taking a loan and in 3 days customers come back, there is no way that 1% of the APR is, let's say, 19% or 10%. But in 3 days, no way the processing fee of 1% will get executed. So you'll have to return back even the processing fee, which is obviously painful to many of us. And also from a customer perspective, borrower perspective, borrowers sometimes may say, okay, even if I'm taking a 6 months loan, if it is very high, or I want to take a 10 days loan, 5 days loan, or even whatever be the reason. Basically, if the customer returns, he doesn't get charged processing fee, nothing gets charged, right? So therefore, there is a chance that some 3 to 5% of loan, I'm also only giving a gut feel, may get returned because suddenly some customer says, yeah, nahi kharidna, mujhe TV nahi kharidna, kharid bhi liya, to I'll give it from my pocket. And that will create an issue or nightmare for banks and NBFCs in terms of liquidity. Suddenly they have given the loan, it will come back. And my other thought process is that since they've already given it in the digital side, I'm sure there'll be a request coming saying when you digital customers have this option of returning the loan within 3 to 14 days, why would it not be offered to the branch? And therefore, what if the 100% of portfolio is now in risk, you disburse, and only after 14 days, you can assume that the loan cannot be returned. And that's going to be a pain. This is already happening on insurance side. So there's little, I mean, this is a new idea, but it'll have a challenge. And it'll also have a challenge for bureaus, because bureaus will have to figure out that how truly they don't have an understanding of, they don't have this return process. So they'll have to also change their credit score evaluation framework to manage and adjust to it. So I think through it, how it will happen, but this is the first take of us of our understanding on it. I think my team, Maitri, would have already shared the feedback form. Please go ahead and share back with us. As I said, many of you are reaching out saying, will I get deck? All those who will share the feedback will get our deck back. So let's continue. And please keep sharing your questions. I'll try to see if I can respond back, and we'll see. And of course, even if the insurance chances are that they will also maybe under trouble, because if the money can be returned, the insurance money also may have to be returned as well. And that will also be a bit of a complications to be handled, right? Overall implication, I think I already spoken about a fair bit. Transparency and all of that, when you do, it will have to, and transparency will increase both sides. So the banks will have further chance to understand how fintechs are operating, and they may want a higher share of the revenue. Because there's a liquidity issue, they will have to manage as the customer can come back. There's a cost of doing business will increase. LOS, LMS will have to develop all the algos and logics and all of the KFS we are doing. They have to adjust. So for example, LOS, LMS of banks will have to have all the complicated revenue making structures of fintechs to be embedded. And many of them may not go through or accepted by the top management as well. Fintechs obviously will have a challenge in selling short-term loans. We'll have to change the systems, processes. So when I say LOS, LMS, they belong to both banks and fintechs. Both will have to do a lot of work out there. Customer, obviously, everything is good for customers. They will obviously avoid short-term. They can see the cost, and they may also use lookup period as a BL alternative. Sad part, but I think some of them may use saying, okay, ek week ke liye chahiye, to kai ko, why take it as a high cost? Take it long term and then return back. And if this is okay, I don't know, that will have a bureau score impact or not, but that has to be looked at. But bureaus will have to do some work to adjust to the lookup period. And of course, fintech generically or the market generically will shift for a bigger ticket loan, because it doesn't make sense to go through all of that for a small ticket loan and all of that issue, right? I think if some of you could share a feedback on a chat that is making sense or not, because I can't take your feedback directly, but if some of you could just quickly say, yes, you are able to follow me, that'll be good for me to sort of understand ki aapko, if you're able to make it, if you're able to follow it up, understand it out. So please say, just say yes, and or maybe say, we are able to understand new pointers out there. We'll see, right? So just a quick request from my side, if you could give a quick feedback on chat, if it is working well for you, and that'll be good, right? So with this, I continue. Just one sec, let me just pick up some water. Okay. So let's move on, right? So there is also a thought process that for whatever documents are shared, whatever is a summary of product, sanction letters, all of that, every statement they has to be digitally signed and given back by the NBFC or bank back to the fintechs. Now, this is the same case today. What happens is many of the fintechs which are working on let's say a neo banking side, they send statement to customer, and also there is a statement which comes from the bank. So I think they're trying to say that ensure that the NBFCs and banks also communicate back to that, so that there's no issue. And they're including the fact that privacy policy of the LSP also has to be shared by the bank or a lender back to the borrower. So this, in this process, there's no fintech in between, and therefore the transparency has to be done. So yeah, fintechs will only have information of reverse, so they have to share information collected back as it goes forward. So the process have to be built on both sides. Right now, fintechs were doing it. Now banks will have to do it and then respond back and to fintech saying they've done it. This is where what the status is. Next is that there's a question coming up saying that, okay, today the many of these fintechs were increasing the limits with time as the performance increased, and it was done on an automatic basis. That's no longer permitted. You need to have consent of the customer before you increase limits. This will obviously increase the friction in the market, and of course, when the friction happens, the usage also goes down. So there'll be a minor impact. I won't say a major impact, but yeah, anything where you have to even say yes or no does go through some pain point. And given that every time you have to do, somebody has to do a full validation, approval, all of that, it will have its own set of challenges to work with. There is also a thought process that these entities, the banks, also have to carry all the economic profile of the customer in an auditable way. I think this should be possible. Looks okay. Most banks should be able to follow it, because any which way underwriting to some extent is done on their side. So they can't come back and say, I don't know much about it, and we had no idea, but the fintech did all the process. They will have to ensure that they can showcase to the bank saying this is our process they've followed, and they can't pinpoint to the fintech and saying get away with it. So that's okay, logical. But again, maybe in some cases where they're not following this process, they'll have to put extra work to get it up. And no, this is a very simple one where they have to say, right now we are saying that all fintechs have to tell all the banks with whom or NBFC they have partnership with. That regulation came some time back. And so already, if you go to any fintech, you will see they're all their lending partners. You go to anyone in the market, you will see all the transparency there. Now they're asking reverse. Every bank or NBFC have to tell with which they have partnership, and some of the details and some of the information products offered with them has to be called out and shared on their platform. So today, when somebody does an ecosystem play and who's partnering with whom, much of it is based on whatever they've understood. Today, it will be transparently available. Everybody will have to tell with whom they have partnership and why they, and the details of the partnership in terms of products offered and all of that has to be shared on their platform. In terms of engagement, and this is again a critical point we need to sort of look at and identify. What our RBI is saying is that when you onboard, when a bank or NBFC onboard a fintech, they have to do a full assessment of the technology capabilities, data privacy policies, storage, audits, fairness, and all of that. So whatever their own platform, their own company was focused on, same has to be applicable to the digital lender as well, and all their own app also has to take care of it. So it's going to be wider influence in the market, but yeah, they have to do it. Technically, even today, there is a regulation from RBI which says that when you have to manage a risk of outsourcing of financial service by NBFC, there's a regulation on that, and there's also a regulation which is relevant for banks. Both of them are very similar by nature. Of course, banks may be slightly larger, but yeah, very similar by nature. Now they're saying it's enforced. Please do not do it like that. You start business and then say later on, you are right now pushed to ensure that you test, validate, audit the partner systems, and then proceed, right? So I think there's a lot of work to be done by banks to ensure that they onboard the right partners, and therefore the cost of doing it, including audits and all, will be, I believe that anyway upwards of 50 lakhs for anybody to onboard. So my take is that larger ones will become larger because the fintechs will be able to take care of it. Many of the entities will do a small experimentation of 1 crore, 2 crore, 50 lakhs. That's no longer going to work because without scalability, without so much of work, let's say 50 lakhs, 80 lakhs spent, it might not work, right? So there's really a need to ensure that you do proper due diligence on the partner, source of funds, process, plan, what many of the banks may not be, and all the security policies, privacy policies, and all of that. So yeah, so there's also implication that new startups will obviously find it difficult to enter and many of the entities will enter with, let's say, 500 crore or 1 crore investment, and they start doing business. I think that's no longer going to work, and sort of a bit of an adverse. So push and pull both. I think in a structured long-term perspective looks good. It'll take fintechs to the level where the all the frauds and all the issues which happened earlier, and there was a lot of discussion on some Chinese app issue which happened in Hyderabad and all that. I think they are trying to curtail that, but it'll also have an impact a bit, obviously, on the banks and fintechs, both to ensure that they comply to the best of their skill set, right? So that's critical, and they'll get audited also for that. So banks will have to take care of that. Every outsourcing partnership, I mean, for example, when they today do an outsourcing of switches, they're accountable for how the switches are running. They physically, when I say switches, I'm looking at, let's say, ATM switch or a card switch, and the team actually goes there and audits on a regular basis. That kind of sort of audits and processes have to be aligned for executing this as well. So very, very deeply to be done. And I have been part of a bank. I know how critical it is to ensure that you comply with it. And RBI also does regular audits and asks for every place where they're outsourced, and what have you done, what kind of an audit reports are tracked, and any outstanding issues has to be resolved as well. So yeah, so I think this has to be done with a lot of people. So I think the fintech teams of the organization will have to get ready for this level of onboarding and this level of process. I think this is also interesting that what they're saying is the LSPs do not store personal information of borrower except for some basic minimal information. And then they have to do regular reviews or audits, right? But how do you define what is basic minimal data? It'll be difficult, right? And what if every bank defines this separately, right? So 5 banks say that this is how they are going to define data, and what can be stored and what can be stored. And what if the LSP actually is offering more services, and they're also, let's say, offering maybe insurance, and they're offering payments, and they're also offering e-commerce. And if they're offering all of that, if you delete some of these services, what will the impact on their service or their overall service? Difficult to figure out. So it'll have to, we'll have to figure out long-term play which will happen, but maybe as SRO structure will come up, and I'll talk about later, as SRO structure will come, that SRO structure where there'll be a group of entities working together with RBI. Maybe that will be played by DLAI, maybe that will be played by FACE. These are all the group entities or maybe a consortiums will have to come back and think how they will actually self-regulate and how do we operationalize it. That's something which has to be done. Again, they're saying that any DLA, which is even the bank DLA, the digital lending app, they have to ensure that that they do not get access to the file, media, context list, all of that. I think there are a lot of discussions saying that it has been misused, so that has to be dropped. And they can only have one-time access to camera, microphone, and location. That, to my mind, is linked to the KYC process. Right? Saying that during KYC, do some stuff, but you cannot have a permanent access to the file and media and context list, and you cannot use it for any other purpose. So I think this and there's a detailed policy guidelines have to be built around storage of customer data, type of data, what is the data restriction, all of that. Again, and there's a pointer on biometric as well. So all of that, how it will be play out when you delete it, what will work. So some level of constraint and some level of data privacy is already built in this framework. I think if you look at the privacy policy, which is the PDP, which was taken off few days back by the government, and they'll come back with the data privacy law again. I think that to some extent, I believe in this document, everything has been sort of applied to. Everybody has to ensure that the privacy is taken care of, and data is not stored randomly without audit, and they cannot share this data. In fact, there's also a regulation somewhere in the depth where these fintechs cannot share data with any third party randomly, right? So I think there are more and more controls coming up. And of course, there's a small item on state level coordination committee. I'll skip, that's not critical. I think from a technology standard perspective, there's a framework saying that please take care of it. So I think if you look at that structure, and then data has to be stored only in India, which is again forced upon many fintechs, digital lending, all the payments guys already had this framework up and running. They had to be stored data in India. We are also saying that, and also there is a IT outsourcing regulation also which came, which is right now actually a discussion paper which is already outside. My request to all of you is that please go through the document. I think sometime back, either I would have done sharing that data or something, some analysis I had done on my YouTube portal on either YouTube, or we had done on LinkedIn, I guess. You can pick it up from there. But we did analysis of that document and what you need to do to comply with it. That is only a draft document for which the feedback is requested. But my gut feel is that largely in total, it'll come up and you'll have to work on it and ensure that you support it, right? I just hope I'm making sense to you guys, right? I think 15 more minutes, and maybe I'll pause now. Maybe I'll run for a few minutes and then pause, right? So another point which came is that all kind of short-term loans will be BNPL will be will be under the credit line or a credit product, and has to be underwritten. So any kind of short-term loan, whatever sake, will be called a loan. It has to be processed appropriately with the bureau score, and which would mean that bureaus will have to handle so many different kind of loans. Maybe they are not built for it. Their algos will have to be taken care of. People tend to do a lot of short-term loans. For example, I'll be honest. I have erred on repaying one of my payment on maybe one of these buy now pay later product, where I think there was a fees of, let's say, 10 rupees per day or something like that. I missed out because it was a small amount, maybe 200 rupees for a ride I had taken. Automatically it was there and I missed out on payment. And if it impacts my bureau score, it will be killing me, right? So I think that the bureaus also have to ensure that they understand these products separately and they do not charge it or they do not impact the bureau score of the customer, because earlier customer were handling only 5 to 10 loans, maybe in 10 years. Today, the customers, I mean, I myself have taken maybe in last maybe 2 years, at least 10 odd loans, and these loans are typically, or maybe not 10, I'm wrong, maybe 50, 60 loans. And these are all small ticket loans. It moves from a laptop to buying, I mean, maybe mobile recharge, any kind of can be into a loan. So I think the cost of BNPL will increase dramatically. And therefore, this segment will not see small ticket loans coming out at all. Buy now, pay later will be typically upwards of the 2,000, 5,000 rupees. 200, 500 rupees of BNPL without any underwriting process will go away because of this regulation. At this point of time, I pause and we'll try to take some questions. Yeah, we'll see what we can cover. I think this session, I know I'm moving a bit fast because of the size of the document. But yeah, I hope if required, I will do one more round of this so that the second part I can capture. But I'll try to do that. I'm just trying to go through some questions which I think my team has already shared with me. I think the Arun is asking this question on what about the access to world data for underwriting purposes? Would fintechs be able to collect such data? But I think my take is that may be at best a one time. Every time they can't do it. Even for underwriting, it's not clear, but I think it should still be permitted. One time is okay, but it can't be used for every time. And if you take one time also, you need to ensure that the consent is taken from the customer explicitly, and you should be able to prove it to the RBI that you took it for this purpose. So that's what my take is. I think Harshal Sharma is asking a question that anything on KYC types or applicability of each type in circular. Not really. I think what very clearly the KYC process has to be followed, where you will actually follow the let's say if you work with a particular bank, you have to ensure that if you're using Aadhaar or you're doing video KYC, you have to use their framework for that, because as an entity, you are not supposed to, don't have access to all that framework at all. So you will have to partner with the bank, technically do it, and therefore most of them already doing it that way. So I think whatever that, I don't know if you call it sub KU process, but you need to work with the bank, because as you are not an NBFC, therefore you cannot have your own access to the bureau, and you'll have to you will not have access to your own Aadhaar stack. So you'll have to partner with the bank and use their KYC process to do that. As an NBFC, you can do it, but as a fintech, you will not have access to that. I think a lot of questions. Then this question can. Then there's a question which is coming from Jay Krishnan, Rajgopalan. Can you share more light on the link between this guideline and the draft on IT outsourcing for RBI? As this is only drafted, yes, that is only a draft. But between there's a regulation even before IT outsourcing. There's actually outsourcing related regulation which already exists, which is issued as far back as 2008. Even NBFCs were given the same regulation, I think, in 2017. and cooperative banks were given the same regulation in 2021. So regulation already exists on outsourcing side. On IT services outsourcing side, they've come back with this draft. Between these two, I think you can use both the frameworks to ensure that you are not off the table at all, and you don't make any mistake, which can be. I mean, this is applicable to banks.
क्या बोला मैंने मिस किया शायद.
Okay, please.
Amir, you are on mute.
I just realized I'm on mute. Okay, guys. So there's a question from Apurva. How will digital lending players using payment gateways for disbursal and repayment will be impacted under the recommendations of REs for disbursal and collect directly from their account to borrower's account? I think they can't collect directly, right? So you may go use gateway and all, but destination account would have to be bank. Bank will have to prove that they are getting the. So it's a proof to be done by the bank that they are getting money directly, and then they paid to the fintech as required. So I think the logic has to be other way around. So it's a responsibility of banks. So you may have all the engineering done, but at the end, banks have to prove that the money came to them and went from them. So it has to be sort of structured around that process. So my take, today registration account may be fintechs. It may not be so as we go forward. Okay, so Nitish question is that any comment on how GST loss can be avoided as the charges are now floating directly to the lenders and LSPs may have to raise invoice for them. Okay, I'm not a GST expert. I really can't tell, but I can tell you one factor is for sure. The bigger problem will be that banks and NBFCs will have higher top line and higher cost. That will look very bizarre, right? For example, when some fintechs charge 8% processing fee, so banks will have to put a 24% revenue and then 8% as a cost. One is cost of capital and one is the cost of service to be given to fintechs. That will look very weird. The entire underlying business model of fintech will also become very obvious to the bank. So it may be having its own repercussions as such, right? So I find that it'll have definite amount of challenges. I'm sure finance guys will now kick in, saying, boss, finance till guys were till now saying that, okay, if as long as 16% hurdle rate is taken care of and you give me FLDG of 5%, it's okay. Now they can see money in their account. And once the money goes in your account, I know every guy has a tendency not to pay, right? So now they'll be reverse. They'll have to, the fintechs will be run. I mean, at least the cash cycle of the fintech will be other way around. Today they pay the money back to the lender, back to the bank, and maybe give the processing fee or some other sharing of revenues on a monthly basis. Now, so they had money for at least some time with them. Now, given in the structure, they will be cash short. So the money will go first to bank and they will pay back. So I think they'll be at a bit of a mercy. And I know I'm a small entity as well. And many fintechs will be smaller. They will find it difficult to get their money back from the lender, right? So a very basic problem, MSME ka problem hai. Okay, so there is a question coming on. Can you describe the different types of LSPs categorized by REs? I think I would really say different types. Anybody who's doing lending is a digital lending, which has an app and which is sourcing the digital journey of the customer is a LSP. There's a clear definition which is given on the document. If you see the first or second page itself, it's clearly written. So anybody who's sourcing the customer digitally end to end will be an LSP, and the LSP technically has to have a app of their own. But if you are working as a BC and you are looking at the villages and you are sourcing on manually, those are the BCs will not be impacted. But let's say if you are a BC and now you are trying to build an app for the customer or the farmer or for inclusion, suddenly you will be also classified LSP, and your BC as a BC you may not have all the impacts, but as a LSP you will have all the repercussions. So it will be a bit of a challenge. So those who are in physical business will be happier in physical business because they don't have to do all the overheads of what you are now to have to do. BCs don't have that much of strict regulation, which digital lending apps will have to adhere to. Let me see more questions coming up. Yeah. This question is SMS scrapping allowed under this, not even one time with consent. My understanding is from a data perspective, at best you can do one time, but later on not. Consent wise, yes, potentially yes. But again, when you read the document, it's difficult to say when you say KYC does not include underwriting. So it is possible that it may not be overall permitted. That question has to go back to RBI saying, is there any condition in which I can pull at least this data? Because I have to underwrite. I have to get some data to underwrite. So I think my take is 80-20, 80% chance it is permitted, but you never know, right? So it's always good to have a direct validation from your legal team, your compliance team, which will have a better understanding than I would have, I guess, because I'm coming more from what I do in the business or my team does in the fintech side, and whatever we have heard, seen in last maybe as a banker, I had seen in maybe 3 years, and now as a consultant, we see in the market for last 5.5 years. So it's more of a market knowledge than a pure regulatory or compliance guy, right? So you should ideally check with your compliance guy, maybe be better informed. Abhishek's question is that, are there repercussions for co-lending fintechs? So look, co-lending fintechs, as long as, so they're obviously logically NBFCs. So everything is applicable to them if they have a own LSP, right? So technically, fintechs, every bank, fintech who has a digital lending app logically and has its own license, they have to follow everything. And also in terms of co-lending, of course, it works. It has its own set of regulation, but for their own sake, they will have to do all these processes on their own. So they have to be compliant as a NBFC any which way. And co-lending is obviously separately to be handled, right? Anushka or Patrick, can you just handle the noise, please? Yeah. Can somebody please handle the noise? Okay, thank you, guys. So I think that's largely, and maybe I know there's more content and I had longer document to handle, but maybe I'll rush through some pointers. And I think the questions are coming. We are also trying to create an FAQ structure. Keep sharing your questions. We'll create a FAQ structure and try to respond back on whatever knowledge and skills we have, limited one, obviously. Maybe please my request is please keep giving your feedback. As I said, all those who will give feedback will get this document back, and we will be happy to share it back to you through email in maybe next 1 or 2 days. Of course, you can reach out to us if you need any advisory. We do this advisory as well for some clients as well. So I think if you need any help, please reach out to us. This is our core business of setting up fintechs, setting up lending businesses, getting partners for banks on the fintech side. That's what we do on profession side. So we'll be happy to help you out if you do reach out, do have any challenge. Also, one request to you, many of you may be struggling here. Many of you may not be able to get through all the content in the session. So this session itself will be recorded and we'll have made available on our if you go to YouTube, in YouTube will be available. You can go to YouTube and pick it up. If you search for the Digital Fifth, you will be able to access all the content. So if you look at previous webinar on, let's say, a digital product manager or funding side or all of that, so all of that is already available. You can pick up some of the podcasts. Some of the most popular podcasts on or webinar on open banking already up and running, so you can check them out. So that's one request. And of course, you can go to our website. So Mota, this whole document will also be made available as a report. So you can pick up, for example, there's a travel service report which is already there. So you can pick up from there. We'll also have the impact. So for example, original regulatory requirement changes which happened few days back on credit card, we had laid out somewhere. So you can pick it up. This is the old one. They came back, right? So we have the framework already there, so you can pick it up. This we teach any which way. If you are trying to learn and all of that, the course is already live. So from that, if you want to pick it up, you can pick it up and learn from there. So you can pick up a report, you can go there. Also, I think some of the content will also be available on our training website. You can pick up from there as well. Matthew, Anushka, you can share the linkage to them if they want to sort of access these platforms, because sometimes it's difficult to follow all the content on real time, right? So you take care of that from there. And let me just go back to the deck. Yeah. And of course, I have not carried and spoken about Annexure 2. Annexure 2 is also sort of interesting because they have a underlying. So on a generic basis, whenever any bureau scores are pulled, you need to inform back to the customer why you pulled and which LSP has pulled and all that. So that's okay, not a very complicated one. There's also a question that all the narration which happens on the digital mode, information corrected and how the fund transfer is written out there, that has to be refined. Now, there's no view how a NBFC can or a fintech can do it. It looks very weird to me. Why it is part of it, I don't know. And they're also saying that banks have to monitor accounts operated from different overseas IP address inconsistent with the KYC process. I don't know how fintechs can, the banks can do it, because this framework will be with LSPs, and these LSPs, the LSPs will be working with multiple banks in multiple customer set, right? So how it will work, I have no idea. Looks very difficult for anybody to do it. So why will I mean, okay, to be honest, difficult for, which means that the IP address from my LSP of the fintech will have to be shared with the bank on a real-time basis, and they will come back and saying stop. I don't know how it will work, so difficult to figure out. And the rest of the process, we are saying that, boss, you should understand the technology standard, all of that. I think for that they can use the draft master direction on outsourcing of information technology. It came, I think, around 2 months back, that you can use. There's also a thought process that REs has to ensure that credit underwriting algorithm is free of prejudice and auditable. And also digital lenders have to focus, ensure that they are ethical. Now, how do you prove it? How the audit will happen, difficult to qualify, because the banks will have to be working with multiple fintechs, and some underwriting is done on their platform, some on their own platform. Complicated, right? So please be aware, it is going to be a challenge for any of you to sort of figure out, anybody to prove this out, ethical, unethical, difficult to figure out. Now comes the most controversy side, FLDG. I'm sure my opinion is slightly different from the market. Now, FLDG, I mean, again, it's a first level thought process. While the document clearly called out when the guidelines were given and they were advisory from working group, they said that there has to be a contractual agreement. I mean, in terms of FLDG side, they have to adhere to some master direction on securitization. So originally, the advisory was that FLDG will not be permitted. And it was clearly written not permitted, right? Not permitted is not permitted. Now, they have linked it to a securitization framework where NBFC partners with the bank for securitization of loans. And there's a framework of 5% MRR or a 10% MRR. There's a risk framework they have already done. Now, if you go with that algorithm, it looks like that they're saying you can do to some extent, but don't overplay with that place. So you can't say 100% FLDG, which was a case with many banks were pushing and many fintechs were going for if they had a lot of capital. That is not permitted. So I think they are calling it like a NBFC malpractice, and you can't do NBFC service anymore. So if you are going for a 30%, 50% FLDG, highly avoidable. If you have a 10% FLDG, I think it should be okay for the time being. I know many of these legal guys are saying that it's not permitted. They are saying that securitization can only be done between two regulated entities, both have to be bank and NBFC. But if that be so, they shouldn't have referred it, because all the entities which are there right now talking about are non-regulated, and they should not have linked it to securitization. So that's my take. FLDG is technically looks like permitted, but only with some limitation, maybe 10% or all of that. That's my take. And NBFC service definitely not permitted. There's more to it, but I'll take a few more questions as I see. And then we'll take it forward. But I think thank you for being with us. I think it's a late evening, very, very late in the evening, and I think so many of you have joined. Again, from a framework perspective, while okay, so I think that many guys are actually, and there's more content to it. I'll not bore you with so much of content, but I think what we'll do is all those who will share this feedback, we'll share the document back with you. If you want to know more, I think, and I know many of you may be thinking, how do you sort of, just one sec, let me just pick up. I'm just lost on the slides. Just one sec. So many of you were asking, how do you connect with us? I think I just wanted to ensure that you have a view on it. You can follow it on these platforms. This document will also be after some time, not immediately, after some time will be shared on our platform. So you can go to our website. You can also go to YouTube. You will be able to see the video as well. So the session itself will be covered there. And of course, in LinkedIn, you can follow us as well. Physically, we are there in 91 Springboard, Lotus, Andheri. And if there is any request you have, if you want to have any kind of consulting session with us to understand this, because that's our bread and butter. So we'll be happy to do that. Any more question I have, I think, let me just see if there's anything else which exists before we close. I think there's a question coming from Ankit Pagaria on the repayment side. How does the mechanism work, wherein lending is built in QR paid payments such as Paytm, BharatPay work? The repayment is deducted from settlement period and passed on to lender. I think from a framework perspective, this logically is not. It can maybe it is okay. This framework should be okay because that's a very clear exception. Basically, it's a revenue based framework where you're saying I will take a share of the revenue. I really suspect that this may not be considered under that framework because it will be falling under that purview that this is the process. It's like in supply chain, this is how the process works. So my first take, this will still remain the way it is, but you never know, right? So I think 90% should be okay. But important that please talk to your compliance guy, take an advisory from him. I'm sure many of you will be deploying them. Make good use of them. And of course, if you want one-on-one some discussion with me or with my other consultants, you can reach out to us on Sameer@the-digital-fifth, and we can reach out. Any other question? Because yeah, there are more coming up. The question is, when will the content be made available on YouTube? I think it will be up and running in maybe a day or two. So I think by I guess 19th, you should be able to see the videos on the YouTube as well. I'm just looking at more questions. If I can respond back in this short period, I'll try to see if I can. If no, and of course, this is as I said, this is part of our logical training sessions which we do. So if you want to join our long-term training session as well, you can sort of reach out to Srikanth at thedigital.com. He is the one who drives all the engagements and processes. And also, if you are looking at any, so we are also doing a very large event in January, and there's a Fintech Bazaar coming up next month. You can reach out to us for that as well. I think Srikanth can actually share those details with you because a lot of B2B transactions do not happen because people don't meet each other. We plan that. So with this, I stop. I know that it's already late in the evening, 7-8. Okay, so given it's already late and the number of people is not very large, now I'm also open for any video questions you want to ask. And for next maybe 5-7 minutes, I can even take a video question. Raise your hand on the system, and then we can go sequentially, and I'll request you to ask. If you have any more questions, raise your hand. We can have question and answer session as well directly without the videos, without the chat. Okay, so maybe one particular question. Was it useful or not? Yes or no? Anybody says, I mean, are you happy with the session? Anything, any feedback, any quick response? Acha laga, bura laga? Useful, not useful? Or maybe ask, am I audible or not? Okay, no responses, no issues. Okay, so with this we close then.
No, I think quite a few people are responding on chat and they're finding it useful.
Okay, perfect. Thank you. So anybody has any question, please, you can raise now, ask me now. On a video as well, you can open your video and ask it. If not, we'll close now. If no, we close now. Thank you guys for joining so late in the evening, and we are obviously available for any discussion. Thank you guys. Thank you.